any reason to believe the improved appetite we see on the screen in the first couple of minutes on the session can continue through the year?
So I think what's holding banks back is part of it is the capital give back story. So banks did suspend, or many of the larger banks did suspend buybacks. But now what's happening is people are starting to question the dividend and the dividend payout, right? Until we get through stress tests, it's going to be very hard for banks to hold that bid. But once we get through that stress test, and if they prove that they don't have to cut the dividend, then I think banks can start to work. The other thing that we have in our favor is energy starting to really bounce. We're more than 50% off the lows for crude or for Brent, and that's a real strong positive for credit, but it's also a real strong positive for the reinflation trade. So I think we have to get through stress tests before banks can really sustain a rally.
Well, some nice demand story coming out of China. According to our reporters here at Bloomberg, that demand for oil in China starting to normalize. This is all playing into this idea that maybe as we start to reopen, as we see positive signs through that reopening, that people will be more encouraged to take that cyclical exposure on. Chris, is that something you're advising people do?
That is. If you recall, several weeks ago, what we were talking about is, and several months ago, was a growth melt-up. Right? And that's occurred. We want to be up in cap. We want to be more defensive. We want to be growthier. But what's happened is there's a ton of value in value. There's as much value as I've seen in value in over a decade. And we were very hesitant on pulling the trigger on value. There have been so many false starts and so on and so forth. But really what got us off our duff was what the Fed did on the credit side. And really in particular, it was a fallen angel. And what we think that's going to do, it's going to push people out on the risk curve and down the capital structure, which is very good for value. More importantly, we're seeing a liquefaction in the credit markets. There's a ton of new issuance that's come to market. Spreads have tightened, and risk is starting to come out of the marketplace, and that's also very good for the situation.
Chris, from what I hear from you, though, this adds up to a tactical short-term trade. You'll get the sequential improvement. We'll start to reopen. People's views on the economy will start to shift. The cyclical side of the equity market starts to pick up. If you think, at best, this economy goes back to what we had before COVID, at best, that's still not a world where you get a very long, drawn-out, sustainable pickup in the valuation of financials. Because if you're going to stay in a relatively speaking low-growth, low-rate world, I don't see why that's a good place to be other than growth, which are the big tech names. And I can see why in the small to short term you can get that tactical rotation. But anything beyond that, anything sustainable for the medium to long term, do you have your doubts, Chris?
I always have my doubts. And I hear you, and a lot of our clients agree with that thought. Hey, there's a good tactical call in value. Hey, it's beginning to bounce. Small caps are starting to perform. Risk is back into favor, but we're not sure how it works longer term. And we understand we're not expecting any sort of V-shaped recovery in the economy. We know there's certain sectors or parts of the marketplace that just won't come back. But the valuations here are a decade. Actually, in the banking space and much of the financial space, valuation is as cheap as we've ever seen it. And when we look at other areas of financials, whether it's credit cards or what have you, things are trading at or below book value. And we think typically when that occurs is there's so much negative pessimism, that growth expectations are so low that eventually what we're going to do and what we're going to see is we're going to see positive revisions as we go forward. And those positive revisions are what's going to make what we think is going to make that rally sustainable. Because if you look at how numbers have come down, they've come down about 25% for the S&P 500, but for your mid and smaller cap stocks, it's 50%. And so you don't need much to really get those positive earnings revisions and to give this story some legs.